Hello, this is Farouk Jaffer, and this video will share our insights to help you achieve better outcomes and improve the probability of reaching financial goals. Upbeat fourth quarter earnings, improving business sentiment, and a Phase 1 US-China trade deal moved US stocks higher to begin the year. Then we experienced the global spread of coronavirus, which brought a swift and sudden reversal. Concern over the human and economic toll has prompted emergency measures from governments and central bankers. Stock volatility is likely to persist as investors weigh the impact on corporate earnings and global supply chains. This caused markets to dip during this period by over 33%. Hugh Courtney developed a framework to help leaders manage uncertainty surrounding strategic decisions. After the recent stimulus bill, I believe we have gone from level 3 to level 2 uncertainty. This is important because stock markets dislike uncertainty, which reflects the current volatility. But we have to be mindful of other risks that are present. Evident by the numbers, the United States is struggling the most with handling the coronavirus. We have the greatest number of total cases and new cases. The problem is that the healthcare system cannot cater to all the people needing help. The United States does not have enough tests to determine if the rate of growth is accelerating or deaccelerating. The standstill in economic activity is another big risk. Public health measures to combat the coronavirus outbreak are set to bring economic activity to a near standstill and cause a sharp contraction in economic growth in the second quarter. This risk also ties into corporate debt, since it will be harder for leveraged companies to make payments. The third big risk is how policy is structured. Last week, jobless claims soared past 3 million to a record high. The government has done a good job with the policy response, but there is worry that it may not be structured properly. For example, payroll tax cuts is more geared toward helping those who are still employed and receiving paychecks. And there needs to be an emphasis on helping small business owners who create lots of jobs. Can this get worse? The market has not fallen as much as it did during the financial crisis or the dot-com bubble. A Goldman Sachs economist recently forecasted an unprecedented 24% hit to U.S. second quarter GDP and expects unemployment to surge to 9%. Indexgurus believes the worst is yet to come, so be prepared to wait in cash for a while longer. Starting in January, we have understood the risks and started to take profits and trim risky assets, leaving them in cash or conservative investments. In addition, we have shifted the majority of investments into high-quality companies in the United States. This transition applied to many of our clients with lower time horizons and lower levels of risk. As you know, markets have weathered serious disruptions over the years and rewarded patient investors. In many of our biggest disasters like the tech bubble, financial crisis, or trade war, keep in mind that markets have often bounced back by over 30% following the next 12 months. Talking about recovery, the image on the left shows the level of certainty that China has since they have the coronavirus under control. The image on the right shows the United States is still increasing the rate of coronavirus cases on a daily basis. Until we get stability and proper testing and healthcare under control, I see markets going through a state of unprecedented volatility. Of the three risks that we discussed today, the coronavirus and economic activity are directly related. That is why index gurus will be jumping back in the market and investing your cash after we pass the peak of corona cases. The pandemic will most likely cause us to pass the peak of the business cycle and go into a recession and possibly a depression. We have to prepare for the uncertainty ahead, so index gurus will be purchasing in small chunks through the phase of contraction. Markets, in our view, will ultimately settle down if three conditions are met. Visibility on the scale of the coronavirus outbreak and evidence the infection rate has peaked over the long term, deployment of credible and coordinated policy packages, and confidence that financial markets are functioning properly. Once we better understand the scale and impact of the outbreak, the policy response will help with a strong recovery. No region has been spared since the coronavirus became a pandemic, yet we see several reasons to stick with U.S. stocks over other developed markets. We believe a focus on quality balance sheets, low debt ratios, and long-term sustainability are important for long-term success. Research has shown that losses are more emotionally powerful than financial gains, which can lead to decision-making during periods of volatility that may hinder long-term returns. You can count on Index Gurus to help you implement our plan of action so that you can achieve your financial goals with peace of mind.